All right, I guess we should have a prayer. Um, anybody, Christy's like driving, so I don't think she can, I mean, she could probably pray, but it'd be weird. Uh,
I can pray.
Katie's willing to help us out.
Our dear, kind, and gracious Heavenly Father, we are thankful for this day. We're thankful for the opportunity we have to come together this evening, and we pray that that will bless us. We're thankful for Brother Fox and his willingness to help us learn and help us to learn these concepts. We pray that we will be blessed in our efforts to learn these concepts. We pray that our minds will be opened, that we might understand, that we'll be able to call to remembrance as we try to apply them, and that we will be able to be blessed as we end our semester, and that we will be blessed in our families and as we try to meet all our responsibilities. And we are thankful for the blessing that it is to gain an education and to attend BYU, and we are thankful for the opportunity that it is. And we say these things in the name of thy Son, Jesus Christ. Amen.
Amen. Thank you very much. So good news, there's no more of those presentations. So, I mean, I think they're helpful. Don't get me wrong. I think they're a valuable thing, but we're always glad when they're done too. So that's the good news. Bad news, got an exam coming up. Nobody loves those. I tried to explain this in my little announcement this week. The way Canvas does grades is it does these weighted categories, right? And so exams is one category, and it carries a weight of 55% or a factor of 0.55. Okay, and so what it does is it takes your average on the exams and then it multiplies it by 0.55, and that's the chunk of the overall grade that is earned through your exam scores. What's good about that is for people who have had low exam scores to this point, that becomes the bar, because their current grade is based on that average exam score. So if you had a 40% average exam score, then any score on an exam above 40% is going to increase your overall grade. And a score below 40% would decrease it, and a 40% score would stay the same. And the other good part about that, or the way they do that, is the final exam is lumped into that. It's not its own category. So again, it's the same sort of hurdle there. You know, if you can score on the final exam roughly what you did on the other exams, then your grade's going to stay relatively flat. The downside is for students who've had high exam scores throughout, right? Because now their current grade is based on a 90%, say, average exam score. So if they have a bad exam and get a 70, which, you know, isn't horrible, it's still passing, but it will bring the grade down. So just, you know, again, if the system gave just pure points to everything and it added up to a total of 2,000 points for the semester, the grades would come out the same at the end. It's just that this system gives you this factored grade throughout the course, and so it can be a little misleading. And what it does is that people with low exam scores feel really discouraged, even though you're like, hey, it's okay, because you know, as long as your overall grade is there. And people with high exam scores kind of can get complacent and think, oh, I'm good, because so I can get a 10% on that in an exam. And I'm like, no, you still need to keep your exam grades up. That was a really long explanation.
We have 2 more exams.
Mm-hmm.
I feel like these last couple exams have come like super close.
Like they're like every other week.
I feel so like
3, 4, and 5.
The first couple were like really spaced out, and then it's like exam 3, exam 4, exam 5 are coming like super on top of each other. So they feel like really close together. So yeah, that's a little overwhelming, but yeah, that's okay.
I think the intent was to not hammer you early on, and then these are every other week, which isn't that close together, but it feels, I agree with you, it feels really close together. You know, I mean, I've been in courses where there's like an exam every week or something, but what's hard about this class, and I think I mentioned it up front, is just the sheer amount of information. Like, it just keeps, it's like a fire hose that opens on day one and it never stops. There's new stuff constantly. And like I said, I teach it at a couple different schools, and it's the same course everywhere. So some accounting gods with a little g okay, all got together and decided that this is what accounting should be in the first and second year accountings. So I guess before I get into talking about the content this week, is any other general questions after I gave my big preamble there? All right, good. So let's take a look at, let's see where I had that. There it is. Chapter 8. Let's see. Hold on. I'm having issues here. That's my whole life, just having issues. I did get to take my granddaughters to the aquarium this week, and that was pretty fresh. Actually, it was pretty exhausting, if we're going to be honest. They're all little, and I'm not used to little kids anymore. Let's see. But still had fun. I was just tired afterward. Okay. Oop. This thing's really giving me problems. Okay, there it is. So let's see. You're seeing my screen. All right. So some of this is the definitional stuff you'll already know. I'll try not to like spend too much time on any one thing here. But this chapter is about plant assets, right? Chapter 8, where we're getting into depreciation and how things depreciate and other ways of depreciating than what we've already learned. We've already learned the concept of like a straight line depreciation a little bit when we learned about our adjusting entries. So for something to be a plant asset, it has to be something that's tangible. And what we mean by that is something like you could actually physically touch, like land or a building or equipment. Like, so tangible in the most tangible definition of tangible, okay? It has to be used in our operations as a business, and it has to be expected to benefit us in future periods. In other words, the whole reason we call something a plan asset is because we don't want to take the cost of it as a single expense right now. What we want to recognize is something we're going to use in future periods, and therefore we should spread the cost of it out as an expense over those periods of time we're going to use it. So the four issues we have to deal with is how we deal with the acquisition or purchase cost, and what all goes into the cost of it, the use, what we're going to do with it during its lifetime, and how we're going to allocate that cost spread out over its useful life. And then finally, the disposal, what we do with the asset on our records when we get rid of it. Disposal sounds like a really harsh word. I mean, it could be throwing something away. It could also be selling it. It just means getting it off of our books and getting rid of the physical asset itself. So the first thing we have to figure out is cost. What does the asset cost us? And so obviously the purchase price, what we pay someone else for, that's part of the cost, but also any expenditures that we need to get the asset ready to use. An example might be like if you bought a big piece of equipment for manufacturing stuff, you're going to have to pay some giant truck to drive it to where you're at probably, and maybe even have like those wide load escorts, right? All of that cost. You're going to have to pay insurance for it while it's being transported. Then it's going to have to be brought into your factory and probably be mounted, like bolted to the floor. And all of those costs, we're going to consider part of the acquisition cost. So not just what we paid the seller for it, but also anything we had to do to get it ready to be used. So like my business is a storage business. And so we get those storage buildings, we buy them in kits. And so we record the amount we pay for that kit. I record the amount that I pay to the concrete contractor who pours a concrete pad. And then I record the amount I pay to my kids and my nephews as we're building the building. And then once it's all ready and we're going to start running it to customers, then I roll all those costs into a single asset, and I call it the building C or D or whichever building it happens to be. So that's how we determine the cost. So this is some examples, like for machinery and equipment, it's the purchase price, the installation price, any taxes, transportation charges, or insurance while it's in transit. For
Brother
building,
Fox.
yeah.
So it lists taxes there, But
Mhm.
is that only initial taxes, like as part of the purchase? But taxes going forward don't roll back. They aren't capitalized, right?
Correct.
Okay.
So it would be like sales tax on the purchase of the
Okay.
materials, okay,
Okay.
but not property tax. Property tax
Okay.
is a period expense that we pay each year or whatever.
Okay.
So buildings, same idea. Um, Things like title costs and closing costs on the buildings, things like that, attorney fees, brokerage fees, all those get rolled into the cost of a building.
Okay.
Remember, land doesn't get depreciated. That's just not how they do land, but land improvements do. So anything we put on the land, paving or curbs or lighting, all of that stuff is called land improvements. And same thing, any of our cost of installation, all of that stuff goes into the acquisition cost of those assets. So we do record the cost of our land. So all of these things go into the cost of the land, but we don't depreciate it. The idea is that we're gonna, that land is probably going to have at least a similar value when we sell it or when we dispose of it. And so we don't depreciate it. I'm sure there's been some really nerdy accounting articles in accounting scholarly journals about why maybe we should consider depreciating land or something, but we just don't, and the IRS doesn't allow it, so we don't. All right, so often you'll do what's called a lump sum purchase, and what that means is you don't usually buy like a piece of land, I mean a building, but not the piece of land that it's on. So when we do buy a piece of land and the building that's on it, the question is, well, how much did we pay for the land and how much did we pay for the building, right? Like that's important to us because we can take an expense through depreciation on the cost of the building, but we can't take that expense for the land. So a lot of times you'll see people really wanting to sort of minimize the amount that's land cost and maximize the amount that's building cost. And so really in real life, what we have to do is we have to go by their relative fair market values. You see that in blue up there. What you do is you have, usually you pay an appraiser to tell you what the fair market value of the total property is, and then what the fair market value of the land and the building is. And then you just use those relative amounts to figure out a factor or a percentage of the total, and then apply that to whatever you paid for it. So here's the example. CarMax paid $90,000 to acquire a group of items consisting of land that was appraised at 40,000 and a building appraised at 60,000. So what we're going to say is, okay, so the land is 40% of the total appraised value, and the building is 60% of the total appraised value. So we'll take that 40 and 60% and then just apply that to the cost. So if our cost was 90,000, then 60% of that 90,000, which would be 54,000, we're going to apportion to the building, and 40% of that 90,000, which is 36,000, will apportion to the land. If you think about it, I don't know how else you would do it. In essence, you have to just make an estimate as to when you paid that lump sum, how much was land, how much was building, and the best way to make that estimate is to have a professional estimator. That's really what appraisers are, right? Give you those values. But it's also very common that our appraised value will be different than our actual purchase value, right? So that's why you use that relative fair market or relative appraised value to apportion the cost. Make sense? I see nods mostly. Okay, I'll move forward. So depreciation, again, in our brain, we get to where we feel like depreciation is sort of like recording the loss in value of an asset over time. That's not really true because some assets actually gain value over time, but we're still going to depreciate them. So depreciate instead really is about allocating the cost to an expense. Think about it. If I bought a building and paid $100,000 for it, and then took that as an expense, purchase of building expense this year, I would have a huge probably loss on my income statement, right? I have that giant expense, and so I would take a loss this year, and then for the next 20 years, I'd be using this building and gaining value out of it, but no expense. And so in those years, I'd have these huge gains. Instead, we'd say, hey, that building has a life of 20 years. We estimate that, and I paid $20,000 for it. So I'm going to just allocate or recognize an expense of $5,000 every year that I have the asset. And at the end of the asset's life, I'll have fully recognized or fully allocated that cost as an expense, just spread out over its life. So try to get out of your brain the idea of depreciation as a loss of value. It's really more about an allocation of cost. So the factors that we have to consider when we're computing our depreciation is the cost of the asset, which we just talked about all the different things that go into the cost. The salvage value, meaning do we think when we dispose of the asset that we will get something out of it? Okay, what's it going to be worth at the end of its useful life? And then finally, the useful life. How long do we think the asset's going to last? And useful life is tricky because it doesn't necessarily mean we think the asset only lasts that long. It means how long it's going to be useful to us. Okay, sometimes assets that aren't useful to us will still be useful to other people. Thus, the thrift store was invented, right? I have a 16-year-old son who goes thrifting with his friends, and I'm just like, that seems like a weird thing for 16-year-old boys to do, but they have money and cars, so they go buy stuff at the thrift store. And they're all proud of they come home and like show us their finds. Anyway, but I think a good example would be like a rental car company. They really only want late model cars with relatively low mileage. So they buy the car, they usually keep it for about 36 to 40,000 miles, and then they auction it or sell it to people. And most of us would say a used car with only 40,000 miles still has a lot of life in it, right? So just think of useful life in terms of the business who's recording it, not necessarily in the asset's overall useful life. All right. So we've already been introduced to the idea of straight line depreciation a little bit when we learned about adjusting entries. And there's a couple of other methods that this chapter kind of takes on. The first is what's called a units of production method, or I guess the second, straight line, then units of production, and then finally the declining balance method. So we're going to kind of go through each of these with an asset that has a cost of 10,000, a salvage value of 1,000. So your cost minus your salvage value is sometimes called your depreciable cost. I've also heard it called depreciable value. Okay, but it's all the same idea. The amount of that cost you're going to depreciate. And then it has a useful life of 5 years. And also has a useful life of 36,000 units inspected. Apparently this is a shoe inspecting machine, whatever that means. Usually I just inspect my own shoes, like, yep, toes sticking out, time to get new ones or whatever. All right. So with the straight line method, we use this formula, which you've already seen before, which is your cost minus your salvage value divided by your useful life in periods. So this we're using annual or yearly periods. So we take 10,000 minus 1,000, divide it by 5 years, and we get $1,800 per year. So at the end of each year, we'll do an adjusting entry to record depreciation expense, where we debit depreciation expense 1,800, and then we credit accumulated depreciation. Remember, accumulated depreciation is a contra asset account. It's an account that's linked with a specific asset account and has its normal balance on the credit side, and it's used to sort of show the book value of the asset. And the book value is always the cost of the asset minus any accumulated depreciation. So that's what that is. So here's a straight line depreciation schedule. You'll see that our book value is $10,000 up front because our cost minus depreciation, we haven't depreciated anything yet, so it's 10,000. And then each year, this is why it's called straight line, we're going to do the same amount, $1,800. Our accumulated depreciation then will grow 1,800, 3,600, and 5,400 up to 9,000 at the end. And you'll see the book value declining by 1,800 each year. At the end of its useful life, we'll have taken a full 9,000 in depreciation expense, and the asset will have $1,000 in book value, which was our salvage cost, which means we've fully depreciated all of the depreciable cost at the end of its useful life. So the units of production method is very similar, except instead of expressing the life of the asset in years, we're going to express it in the units of production, meaning how many units this asset will produce. So in a car, the units of production would be miles driven, right? That would be, we'd say, we think, you know, we're going to drive this vehicle till it has 100,000 miles on it. So we'd say 100,000 units of production on the car. So again, we take the cost minus the salvage value and then divide that by the total units of production. And that will give us our amount to depreciate per unit of production. And then to find our depreciation expense, we just take the depreciation per unit times the number of units that we produced during that given year or given period of time. So here we have our cost was 10,000, our salvage value is 1,000, so our depreciable cost is 9,000. We believe the asset has 36,000 total units in its useful life. So that means we're going to depreciate 25 cents per unit produced. So then to find our depreciation expense for a given period of time says that in the first year, we depreciated 7,000 units. So we're going to take 25 cents per unit times 7,000 units, and that'll be the amount of our depreciation expense for that first year. So again, in a problem that's asking you to do this, it's going to have to tell you the total number of units in the asset's useful life, and it's going to have to tell you how many units were used each year, right? You'd have to have that information to figure this out. So there's the depreciation schedule. Again, at the end of it, after they've made 36,000 units or inspected 36,000 units, we'll see that all $9,000 of the depreciable cost is depreciated, leaving us with a book value of $1,000 at the end. All right, the most confusing one, the declining balance method. So with the declining balance method, what we're doing is the first thing we do is calculate the straight line rate, okay? So to calculate the straight line rate is just to take 100% and divide it by its useful life. So this asset that has 5 years in its useful life has a straight line rate of 20%, meaning if we were doing straight line depreciation, we'd be doing 20% of the cost each year, okay? Then, and if this is called the double declining balance method. Just so you know, there's also like 1.5 declining balance method. So you do a factor of 1.5 instead of 2 on the double declining balance. There's more than one style or a type of declining balance method, but it usually is just how much of the balance are we going to depreciate each year. So for this book, I think we always do double declining balance method. So all we do is we double that straight line rate. So if our straight line rate is 20%, then 2 times that would be 40%. And then to find our depreciation expense, what we're going to do is we're going to take our double declining rate times the balance or the book value at the beginning of the period. So with straight line, we use that rate times the total cost. So it's the same amount each period. But with declining balance method, it's always times the balance, or which another way of saying that is the book value at the beginning of the period. So here we could see, and you'll also see that they don't factor in that salvage value up front. Okay, so that's an interesting thing too. We don't worry about salvage value till the end when we're using the double declining balance method. So again, our rate was 20%, we doubled it to 40%. So in the first year, we have a cost of 10,000, or sorry, a beginning book value of 10,000. Multiply that by the rate, we're going to depreciate $4,000 in that first year. So then our accumulated depreciation will be 4,000. So the cost minus the accumulated depreciation will give us a book value of 6,000 at the end of the first year. That will be our beginning balance at the new year. We'll multiply that by the rate. So in this case, the rate stays the same. We're just multiplying it by the beginning book value. So what's happening is the amount of depreciation expense gets weighted more heavily at the beginning of the asset's life. And we know a lot of assets actually do that. They lose a lot of value up front. And then that rate of, again, this isn't about losing value though. It's about allocating costs. But often you do want to sort of make your cost allocation match up with values if you can. So We just keep doing that. And then when we get down to the last year, instead of worrying about the 40% rate, we just say, well, how much do I have to claim as depreciation expense this year to be left with my salvage value? So if at the beginning of that last year, it had $1,296 in book value, and I know I need to have 1,000 at the end for my salvage value, then I just, in essence, I just take 1,296 minus 1,000, and that tells me how much to depreciate for that last year. Really, in the last year, we're just saying, what do I have to depreciate in order to be left with the appropriate book value that equals our salvage value at the end of the year? All right, so there's the three methods.
A quick question on that.
Yes.
I'm sorry, I might have missed it, but did you have an example of where that is typically used?
Not really. So here's the thing: is like businesses are free to use whatever method they want to use. Okay. I'll tell you, most people just use straight line because it's easy, and because the IRS has these schedules, MACRS, if you've ever seen those. Sometimes people call them the makers schedules. And in essence, you look up the type of asset, and then it just tells you like its useful life, and you just use that. And then, you know, the IRS is never going to question you because you use their schedule and their table. And so that's what most people do. So I don't really have a good example of like in this industry, double declining balance is used the most or anything like that. Sorry, I could probably look something up and see if there's.
No, no worries. I was just curious.
The problem with all of this is that we don't always purchase every asset we purchase on the 1st of January so that it goes into, you know, so that it perfectly lines up with our year, or on the first day of our fiscal year. Okay. So a lot of times our first year will have like a partial year's worth of depreciation on it, and our last year will have a partial year, right? And that's pretty normal. So here's our example. We purchased this one on October 1st. And it's straight line depreciation. Why is this thing going so slow? Okay. So we would take the cost times the salvage value divided by the life in years, and then multiply that by, this is purchased October 1st, so it's going to be October, November, December. It's 3/12 of a year that we're depreciating in this first year. So that's all the depreciation will take for that first year. So just recognize that sometimes you have to read the problem carefully to realize, because they won't tell you, hey, they're only depreciating 3 months. They'll just say they purchased the asset on October 1st. And then you're supposed to recognize, oh, that's only 3 months worth. And so it's kind of tricky. So sometimes things may happen where the predicted salvage value or predicted useful life of an asset changes. You know, maybe the thing that we thought was going to be worth $1,000 at the end of its useful life is now going to be worthless, or maybe it's going to be worth $5,000 because the market is really appreciated. And so we can make changes to our depreciation in the middle of the process if we have to. Okay. And so all we do then is go back and say, okay, starting from today, where we're making the change, what's the useful life from here forward? What's the book value of it right now? What's the salvage value? And we recalculate it. Also recognize that sometimes we will add value. This was the question Katie asked earlier. She even used the right term. She asked if we would capitalize the taxes. Capitalizing just means adding certain costs into the cost of the asset. Okay. So typically anything that's going to provide benefits that are for longer than the current period. So if it's going to extend the life of the asset or make the asset more valuable for, you know, for the rest of its life, we're going to roll that into the cost of the asset and then recalculate our depreciation using that new changed cost. So, you know, common examples, this doesn't include things like maintenance. Okay, people think of that because they're like, maintenance is going to extend the life of the asset, and you're like, well, no, maintenance is really something that we're supposed to do to make it last its normal life, right? And so, but you know, if I had a building and I built like an entire new wing on the building or something like that, that's going to add value to that building that's going to last through multiple accounting periods. If I had a piece of equipment and I made a modification to it that's now going to make it last 5 years longer than what we originally thought it would, that we would capitalize at the cost of doing that. But things like things like our regular maintenance, those are all what's called revenue expenditures. Those are just costs that we claim as an expense during the current period. So here's some examples. Ordinary repairs, we're going to call that a revenue expense, or betterments and betterments. I don't know, like I think it's more better if you do that. It's more betterer. I don't know. And extraordinary repairs to capital. I don't know that that's really helpful, but thanks, McGraw-Hill. All right. All right. So if we do an ordinary repair, then we just record that as a debit to repair expense and a credit to cash. Whereas an improvement or a betterment, we're going to actually debit the asset account and credit cash. So we're actually increasing the value of the asset. All right. So the last thing we got to do is what happens when we get rid of this thing. So we have to record it. What we have to do is we have to get rid of the asset from our books, and the asset is going to always be listed on our books at its cost plus any betterments we've added to it. And so we're going to have to credit that because it's going to be a debit, right? We're going to have to credit that to get rid of the asset off our books. Also, any accumulated depreciation for the asset is going to be listed as a credit. So we're going to have to debit accumulated depreciation to get that off our books. Then we're also going to either debit cash that we've received, like if we sold it to somebody, or credit any cash we paid, like if you had to pay someone to take it off your hands, which happens sometimes. And then the difference between all of that is either going to be the gain or the loss. So I tend to try to think of it in those ways, where some people like to calculate out the gain or loss. They'll actually write down subtract the asset, add the accumulated depreciation, add the cash received, calculate out what the gain is, and then they do their journal entry. I like to just I do it with the journal entry and do all three of those things: record the cash received or paid, remove the accumulated depreciation, remove the asset, and then just whatever makes my journal entry balance, whether it be a debit or a credit entry, I know that becomes my gain or my loss. And I know that if it's on the debit side, it's a loss because that's where expenses get recorded. And if it's on the credit side, then it's a gain because that's where revenues or increases get recorded. That works for my brain, but you can do it whatever way makes you happy. I know what you're thinking. None of this makes me happy. All right. But whichever way seems logical. Oh, that may not work either. None of this. Okay. A machine costing $9,000 with accumulated depreciation of $9,000 is sold. The company is depreciating the equipment, the straight line method over 8 years with zero salvage value. So in this case, we're discarding an asset that's fully depreciated and we're discarding it. So we're not getting any cash. And there's no salvage value or anything else. So that's pretty easy because we're just going to debit the accumulated depreciation account. So now that accumulated depreciation account will be zero. We'll credit the asset account. That'll be zero. We didn't receive any cash and there's no gain or loss. So that one's pretty easy. Here we have equipment that costs $8,000 with accumulated depreciation of $6,000. So it's not fully depreciated. The company is using straight line depreciation over 8 years. So this is one of those where they tell us they're selling this or discarding this asset on July 1st. So it's easy to miss that because it doesn't tell you, hey, make sure you update depreciation up to the date of the sale. It just tells you they're selling it on July 1st. And it tells you the accumulated depreciation of 6,000 was current up to December 31st of the previous year. So whenever we sell something, the first step is always to get our depreciation up to date at the time of the sale. So if it had depreciation recorded up till December 31st, we're going to have to do January 1st through June 30th, which is 6 months worth. So we'll take, let's see. So it has an 8-year useful life, 0 salvage value. So I take 8,000 divided by 8. We're depreciating 1,000 a year. The fact that we're selling it halfway through the year means to get that up to date, I'm going to debit depreciation expense 500 and credit accumulated depreciation 500. That's my depreciation entry at the time of sale. Then I can do my not sale, but discarding. So if I had a $6,000 balance in my accumulated depreciation and I've just added another 500, added 500, my balance of my accumulated depreciation account is now 6,500 credit side, right? So I'm going to debit accumulated depreciation 6,500. I'm going to credit the asset 8,000. And then again, this is how I do it. Okay, I debit the accumulated depreciation, credit the asset, and then I look, well, what does it take to balance this? And it takes 1,500 on the debit side, so that's going to be a loss. That's my process. I could have also said equipment minus accumulated depreciation is $1,500, and since I'm losing 1,500 on it, and then I could have made the journal entry. Some people like to do that too. All right, so here I'm going to sell a plant asset at its book value. So on March 31st, we sell equipment that originally cost 16,000, has accumulated depreciation of 12,000. So I use straight line depreciation of at $4,000 per year. We're selling it for 3,000 cash. So first thing I have to do is I have to update my depreciation to the date of the sale. So if our depreciation is 4,000 a year, and I'm selling it at the end of the March, that's 1/4 of a year. So I'm going to have $1,000 in depreciation expense to update that depreciation at the time of the sale. So I had a balance of my accumulated depreciation account of 12,000, and I just added another 1,000 to it. So now it's 13,000. So now to record the sale, I'm going to record the cash I received, which was 3,000. I'm going to debit the accumulated depreciation account, 13,000. And then I'm going to credit the asset account, its total cost of 16,000. In this case, they balance, and so there's no gain or no loss on that sale. I sold it for what its remaining book value was, in essence. Here we're selling one at above book value. So again, first step, figure out our accumulated depreciation expense up to the date of sale. And then we'll say we'll debit the cash we received. We'll credit accumulated depreciation for its balance. I'm sorry, debit accumulated depreciation for its balance. Then we'll credit equipment. And then now I can see there's 20,000 on the debit side and 16,000 here. So I must have to credit $4,000 to make this journal entry balance. Since it's a credit, that's a gain. So that'll be my gain on disposal. Again, that's how I like to do it. I hope it makes sense to you. I'm actually about out of time. I have another class starting. I apologize. I know we had to start late today. And that was my fault too, or I guess I could blame it on my boss, but it's my fault for having a job. Anyway, so I've got to let everybody go. In fact, class it's 6 o'clock here, 7 we're in where you're at, but 6 where I am. So have a great night, everybody. I'm sorry I don't have time to answer any questions. I've got to get to class. If you do have some other question, send me an email and I will, as soon as class is over, I'll come back and get it answered. All right, have a great night.
Thanks, Brother Fox.